with the impending recession, is it better to save in a high yield savings account than invest? So here is something you'll hear me say, and I'll sound like a broken record, but it is retail investors. And when I talk about retail investors, I'm talking about people like everyday people like you and me are notoriously terrible at timing the market. And so what do I mean by timing the market? I mean that if you looked at how the market performs over time, so if I just bought in and held and just got the benefit of whatever the market does over time, all the ups and downs along the way, in general, over a very long period of time, the market returns about 9 to 10% a year. And that includes years like last year that were down 20%. It also includes the years when the market is up 30 or 40%. And nobody ever perfectly knows exactly when it's going to shift. And so what happens is that if you looked at the performance of general retail investors, they always trail the performance of the market as a whole. And here's why it's really hard to time the market. It's really hard to time the market because you have to be right twice. You have to sell at the peak and you have to buy in at the very bottom. And most people don't do that, right? Most people see the market starts to sell off. It's down 10, it's down 15, it's down 20. They sell, and then the market starts to recover again. So they sold at the bottom, usually, or near the bottom. And then when the market starts to recover, they buy back in again. And so oftentimes they miss out on buying at the bottom too. And so that is why, as a whole, retail investors trail overall market performance because they try to time the market and they get it wrong. Here's the thing about timing the market is that the market is a leading economic indicator. That means like it sold off over all of 2022. Nobody's officially announced an economic recession yet. Like the powers that be that declare these things still haven't officially declared that we are in a recession. And yet the market sold off for all of 2022. The market is also going to start to recover before anybody declares, hey, the recession is over. It's just the way it works. It is a leading indicator. Investors invest in the stock market and share prices are based off of investor expectations of what is to come, not what has already happened. And so the market is always going to be roughly 6 to 12 months ahead of what the real economy is actually doing, if that makes sense. And so my perspective to people is what matters more than timing the market is time in the market. So time is your most valuable resource when it comes to investing, because the more time that you are in the market, the more time you have for your investments to compound. And compound just means when you put money in and it earns a return in a given year, then the next year you earn a return on that return. That is the compounding effect. And you need time in order to make the most of that. So you are far better off kind of having investing consistently on a regular basis for the long term than you are trying to set cash aside and pick and choose your points. Just because humans tend to react emotionally, we tend to kind of have this herd mentality and we tend to get it wrong. And so that would be kind of my 2 cents and is my general advice when it comes to investing broadly as a whole. Don't try to time the market. Retail investors lag the market performance as a whole because they try to time the market. You're much better off taking advantage of that long-term average market performance, which includes those ups and downs along the way. And oh, by the way, if you look historically, and I'll make the caveat that all financial people make, which is that past performance is not an indicator of future performance, but it's the best indicator that we have. And if you look at the past performance of the market in those years where the market is down really big, the subsequent performance afterwards tends to outperform. So in general, the way I would look at it is that the market is down 20% right now. It's on sale. And historically speaking, when the market has had these bear market downturns, the recovery has been pretty solid over the mid to, call it the next 2 to 5 to 10 years. And so that's kind of the way to think about it. So I hope that helps. I'm still staying the course. We're still doing what we always do. We aren't trying to time the market is kind of my personal behavior.